The number is simple, thought $30 trillion. It is easy to say, easy to display on a screen, hard to truly understand. Total U.S. federal debt has moved beyond $30 trillion, and it continues to grow. But the size of the debt is only part of the story. The more important shift is happening beneath the surface. Interest payments on that debt are rising quickly, in some years faster than defense spending, faster than healthcare spending, and faster than many other core parts of the federal budget. This is not a political argument. It is a math problem. For years, debt expanded in an environment of near-zero interest rates. When rates are extremely low, borrowing feels manageable. $1 trillion financed at 1% carries a very different burden than $1 trillion financed at 5%. The structure looks stable because the cost was contained. But interest rates have changed. As older debt matures, it must be refinanced at today's higher rates. That refinancing does not happen all at once. It happens gradually, month after month, year after year. Yet the effect compounds. Bonds issued in a low-rate world are being replaced with bonds issued in a higher-rate world. This is the core disruption. Debt is no longer just large. It is becoming expensive. When borrowing costs rise, interest expenses begin to climb even if new spending does not increase dramatically. In other words, part of the budget growth is no longer going toward new programs or investments. It is going toward servicing past decisions. And here is the calm but powerful question. When debt compounds faster than national income, who absorbs the pressure? In a growing economy, rising debt can feel manageable because tax revenues expand. Growth masks strain. But if interest costs rise faster than economic output, the balance shifts. A larger share of national income must be directed toward debt service. That changes priorities. The government can respond in only a few broad ways. It can cut spending elsewhere. It can raise taxes. It can borrow more. Or it can rely on monetary policy to ease the burden indirectly. Each path carries consequences. For decades, falling interest rates acted as a cushion. As debt grew, rates declined. That combination made the system appear stable. Investors were willing to buy government bonds at low yields. The Treasury could refinance cheaply. The math worked. Today, the math is different. Higher rates alter the entire equation. What once looked sustainable begins to feel tight. What once felt temporary begins to look structural. And the impact does not remain inside government spreadsheets. Sovereign debt influences the value of the currency. It influences the bond market. It shapes banking balance sheets because banks hold large amounts of government securities. It affects pension funds and insurance companies that rely on bond stability. It filters into mortgage rates, credit card rates, and business loans. Debt is not isolated. It is woven into the financial system. When interest expenses rise rapidly, markets pay attention. Not because default is expected, but because flexibility narrows. A government with rising mandatory interest costs has fewer options during downturns. Stimulus becomes harder. Emergency spending becomes more expensive. The shift from debt is manageable to debt is expensive changes behavior. Investors may demand higher yields to compensate for fiscal uncertainty. Higher yields increase costs further. A feedback loop can begin, not through panic, but through rational adjustment. This is why the conversation around $30 trillion matters now, in a way it did not a decade ago. The environment has changed. The cushion of ultra-low rates is gone. None of this implies sudden collapse. Advanced economies rarely experience dramatic sovereign defaults. Instead, pressures build slowly. Policies adjust gradually. Purchasing power shifts over time. But the underlying question remains. If governments owe more and must pay more to service that debt, the cost does not disappear. It is absorbed somewhere through higher taxes, lower spending, increased borrowing, currency adjustment, or reduced real returns for savers. Savings, after all, are claims on future purchasing power. They depend on currency stability, bond market confidence, and economic growth. So the real issue is not the headline number. It is the interaction between debt levels and interest rates. It is the timing of refinancing. It is the trajectory of fiscal policy in a world where borrowing is no longer free. And that leads us to the next critical shift. For years, the system operated under one unwritten rule. Debt could expand because rates would remain low. If that rule is now breaking, the signal will appear first in the bond market and in the cost of servicing the debt itself. For more than 3 decades, the system followed a quiet pattern. Debt expanded, but interest rates trended downward. Each recession brought rate cuts. Each crisis brought liquidity. Governments borrowed more, yet the cost of servicing that borrowing often declined as yields fell. The decline in rates masked the rise in principal. This created a powerful assumption. Debt levels mattered less because financing costs were manageable. When 10-year Treasury yields moved from 8% in the early 1990s to near zero in the 2010s, refinancing became easier with time. Old debt could be rolled over at lower rates. Interest expenses remained contained even as total borrowing increased. Falling yields acted like a release valve. But that era may be ending. The shift from zero-rate policy to structurally higher yields changes the foundation of the model. When inflation accelerated, central banks raised rates aggressively. Policy rates moved from near zero to levels not seen in over a decade. Bond yields followed. Now the Treasury faces a different refinancing environment. The United States does not repay its debt in one lump sum. It rolls it over. Treasury bills, notes, and bonds mature continuously. When they mature, new debt is issued to replace the old. This process works smoothly when rates are stable or falling. It becomes expensive when rates are elevated. Imagine refinancing a mortgage at 3% versus 6%. The balance may be the same, but the monthly payment is very different. The same principle applies at the sovereign level. Trillions of dollars issued during the low-rate period are maturing over the next several years. As they roll over into higher-yielding securities, annual interest costs increase. This is mechanical. It does not require new spending decisions. It is built into the calendar. The big signal is not simply that debt exceeds $30 trillion. It is that the cost of carrying that debt is rising quickly relative to tax revenue and GDP. When interest payments begin to rival or exceed categories like defense or healthcare, fiscal flexibility shrinks. More of the budget becomes fixed. Less is discretionary. Policymakers have fewer options during downturn. This is where bond markets come into focus. Investors who purchase government debt evaluate risk and return. If inflation expectations remain elevated, or if fiscal deficits widen, they may demand higher yields as compensation. Higher yields increase borrowing costs. Increased borrowing costs expand deficits further. The cycle can reinforce itself. This is not a crisis spiral in the dramatic sense. It is a compounding dynamic. Bond markets are often described as the most sensitive barometer of fiscal credibility. They react not to political rhetoric, but to supply and demand. If issuance rises significantly and demand does not keep pace, yields adjust upward. Higher yields ripple outward. Mortgage rates track long-term Treasury yields. Corporate borrowing costs rise. Asset valuations adjust to reflect a higher discount rate. The effects are broad. The year 2026 is emerging as a pivotal point because of the maturity schedule. A substantial amount of debt issued during the low-rate years will need to be refinanced by then. If rates remain elevated, the interest burden increases meaningfully. If rates fall sharply, the pressure eases. The path of policy and inflation between now and then matters. The key insight is this: the risk is not sudden default. Advanced economies that borrow in their own currency rarely default outright. The risk is cumulative strain. Strain shows up as persistent deficits despite strong employment. It appears as debates over spending priorities. It surfaces in bond auctions that require higher yields to clear. For decades, the unwritten rule was that debt expansion could continue because rates would trend lower. If that rule is breaking, markets will adjust accordingly. And when markets adjust, the impact does not stay confined to Washington or Wall Street. It spreads through the institutions that hold this debt and the countries that finance it. Which raises the next question. If the United States must continually refinance large obligations at higher rates, Who is willing and able to absorb that supply? And how might global power dynamics shift as a result? If refinancing pressure is building, the next question is straightforward. Who is funding it? US debt does not sit in isolation. It is distributed across a wide network of holders. Domestic institutions such as pension funds, insurance companies, mutual funds, and commercial banks hold a large share. The Federal Reserve holds a significant portion. Foreign central banks and sovereign wealth funds also own trillions in treasury securities. This global distribution has long been a source of strength. The dollar functions as the world's primary reserve currency. International trade is often priced in dollars. Energy markets clear in dollars. As a result, foreign governments accumulate dollar reserves and recycle a portion into U.S. debt. For decades, this system created steady demand. But global conditions are shifting. The United States runs persistent trade deficits, meaning it imports more than it exports. Those dollars sent abroad often return in the form of purchases of U.S. assets, including treasury bonds. This recycling mechanism has helped finance deficits smoothly. However, geopolitical tensions, sanctions policies, and shifting alliances are changing incentives. Some foreign central banks are diversifying reserves, not abandoning the dollar, but reducing concentration risk. If even a small portion of incremental reserve growth is directed elsewhere, marginal demand for treasuries weakens. At the same time, domestic fiscal deficits remain large. That means issuance continues at scale. If foreign demand slows while supply remains elevated, the burden shifts inward. Domestic institutions must absorb more. Commercial banks are one such buyer. They hold treasuries as high-quality liquid assets. But banks also face their own balance sheet constraints. As discussed earlier, higher rates reduce the market value of existing bond holdings. Adding more, long-duration exposure increases sensitivity to rate volatility. If banks become larger holders of government debt while managing tight capital ratios, systemic exposure rises. Pension funds and insurance companies also participate. They value predictable income streams, yet they too operate within risk frameworks. If yields rise due to heavy issuance, their portfolios adjust, but volatility increases. The Federal Reserve represents another dimension. During periods of quantitative easing, it purchased large volumes of government bonds, supporting prices and suppressing yields. In a tightening cycle, it allows bonds to roll off its balance sheet. That shifts more supply to private markets. All of this feeds into a central tension. The largest sovereign borrower in the world must continually refinance its obligations. That refinancing depends on trust, liquidity, and global demand. Now consider commodity exporters and emerging markets. Energy producers accumulate dollar revenues. Historically, those revenues flowed back into dollar assets. But if policymakers in those countries perceive long-term dollar dilution, risk whether through sustained deficits or monetary accommodation, they may seek diversification. This does not require dramatic shifts. Even incremental allocation changes matter at scale. Emerging markets also watch interest rate differentials closely. If US yields rise, capital can flow toward dollar assets, strengthening the currency and pressuring other economies. If U.S. policy shifts toward yield suppression to manage debt costs, the dynamic changes again. The real battle, then, is not about a single auction or a single deficit number. It is about leverage. Leverage in this context means influence over funding conditions. If global investors are confident, refinancing remains smooth. If confidence weakens, yields adjust upward, increasing costs further. The United States retains significant structural advantages: deep capital markets, legal stability, and global reserve currency status. Those advantages do not disappear overnight, but they are not immune to gradual shifts in allocation. As refinancing needs grow into 2026 and beyond, the interplay between domestic absorption and foreign participation becomes critical. If foreign buyers reduce marginal demand and domestic institutions face constraints, yields may need to rise to attract capital. Higher yields, in turn, influence everything from mortgage rates to equity valuations. This is how national debt statistics connect to global power dynamics. Debt at scale becomes a geopolitical variable. It shapes alliances, trade flows, and currency strategies. It determines who finances whom, and at what price. And once we recognize that this is not just about arithmetic, but about monetary leverage, the next step is clear. If financing conditions tighten or shift, what happens to the currency itself? And how does that translate into the long-term purchasing power of savings? If financing conditions begin to shift, the currency sits at the center of the adjustment. Every major debt cycle eventually intersects with money itself. Governments that accumulate large debt loads face a limited set of historical pathways. They can grow their way out if economic expansion outpaces borrowing. They can impose austerity, cutting spending or raising taxes to narrow deficits. They can allow higher inflation to erode the real value of outstanding debt. Or they can rely on financial repression, policies that keep interest rates below inflation, quietly reducing the real burden over time. Each path affects currency, purchasing power. Strong growth is the least disruptive solution, but it requires productivity gains and demographic support. Austerity can stabilize balance sheets, but often slows growth in the short term. Inflation reduces real debt burdens, but weakens purchasing power for savers. Financial repression operates more subtly, transferring value gradually from savers to borrowers. In the current environment, the tension lies between high interest rates and high debt levels. If rates remain elevated, interest expenses consume a larger share of the budget. That strains fiscal flexibility. It may require either spending reductions or increased borrowing, both politically difficult choices. If rates are suppressed to ease that burden, another risk emerges. When yields are held artificially low relative to inflation, real returns decline. Savers earn less in inflation-adjusted terms. Over time, this functions as a quiet transfer. This is where the concept of fiscal dominance becomes relevant. Fiscal dominance occurs when monetary policy becomes constrained by government financing needs. Instead of central banks setting rates purely to manage inflation or employment, policy decisions are influenced by the sustainability of public debt. The independence of monetary policy narrows. This does not mean hyperinflation. It does not require currency collapse. It simply means that policy choices increasingly reflect debt management priorities. Currency debasement in advanced economies is rarely dramatic. It unfolds gradually. The purchasing power of savings erodes over years rather than weeks. A dollar today buys less 10 years from now, even if the decline feels incremental. For households, this matters more than headline debt figures. Savings accounts, bond portfolios, and fixed incomes are denominated in nominal terms. If inflation averages above those returns, real wealth declines slowly. The effect compounds quietly. This is why discussions around debt and currency cannot be separated from purchasing power. Gold and other hard assets are often discussed in this context. Historically, during periods of sustained inflation or financial repression, tangible assets have preserved value relative to currency. That does not make them immune to volatility, nor does it guarantee performance. But it explains why they re-enter conversations when fiscal trajectories appear stretched. Inflation-sensitive investments and diversified asset allocations are debated for similar reasons, not as speculative trades, but as responses to uncertainty around real returns. The deeper point is structural. If debt expansion continues and refinancing occurs at higher rates, policymakers face trade-offs: allow rates to remain high and strain budgets, or manage yields and risk eroding purchasing power. Neither path is catastrophic by default, but both influence long-term savings outcomes. Currency stability rests on confidence that fiscal paths are sustainable, that inflation remains controlled, and that policy remains credible. When confidence weakens at the margin, capital reallocates gradually. The risk to savings is not sudden confiscation, it is subtle dilution. A savings balance can appear stable in nominal terms while losing ground in real terms. That distinction becomes critical in high-debt environments. Understanding this dynamic reframes the conversation. The question is not whether debt will trigger collapse. It is how the system will distribute adjustment costs over time. and those costs eventually filter down to everyday financial decisions. How do higher government borrowing costs influence mortgage rates? How does currency pressure shape credit conditions? How should individuals interpret long-term purchasing power risk within their own balance sheets? To answer that, we move from sovereign math back to household reality. If refinancing pressure intensifies and global buyers reassess their exposure, the adjustment eventually shows up in the currency. Debt at scale does not operate in isolation. It interacts with money creation, interest rate policy, and long-term purchasing power. When sovereign debt expands faster than economic output, policymakers face a narrow range of historical outcomes. One path is growth. If the economy expands rapidly enough, rising tax revenues can outpace debt servicing costs. The debt-to-GDP ratio stabilizes or falls. This is the least disruptive solution, but it requires sustained productivity gains, strong labor participation, and favorable demographics. Growth cannot be legislated. It must be generated. Another path is austerity. Governments can reduce spending or increase taxes to narrow deficits. This strengthens fiscal metrics on paper, but often slows economic momentum in the short term. Political resistance is common, especially when interest costs are crowding out other priorities. A third path is inflation. Higher inflation reduces the real value of outstanding debt. If wages and nominal GDP rise faster than interest expenses, the burden shrinks relative to the economy. However, inflation also reduces purchasing power. It transfers value from savers to borrowers and from fixed-income households to asset holders. A fourth path is financial repression. This approach is more subtle. Interest rates are kept below the rate of inflation for extended periods. Savers earn negative real returns, while governments refinance at relatively low nominal costs. The debt burden declines slowly in real terms without overt default or hyperinflation. Each option influences the currency. When debt servicing becomes a larger share of the budget, monetary policy decisions carry additional weight. If rates remain elevated to combat inflation, interest expenses rise, widening deficits. If rates are reduced to ease fiscal strain, inflation risks reappear. This tension is often described as fiscal dominance. Under fiscal dominance, monetary policy becomes constrained by government financing needs. Central banks may still speak the language of inflation targeting, but practical decisions increasingly consider debt sustainability. Yield curves may be influenced directly or indirectly to ensure borrowing remains manageable. This does not require overt coordination. It emerges from structural necessity. For savers, the distinction matters. If rates stay high and inflation moderates, nominal returns may improve, but economic growth could slow under fiscal strain. If rates are suppressed while deficits persist, real returns may decline even if nominal balances appear stable. Currency debasement in advanced economies rarely looks dramatic. It is not usually a sudden collapse or overnight devaluation. Instead, it unfolds gradually. A steady decline in purchasing power over years. A slow rise in asset prices relative to wages. An environment where maintaining real wealth requires more risk. The erosion is incremental, which makes it harder to recognize in real time. Savings accounts, bonds, and fixed incomes are denominated in currency units. If those units lose purchasing power faster than returns accumulate, real wealth declines quietly. Compounding works in reverse. This is why assets perceived as stores of value often re-enter the conversation during periods of elevated debt and fiscal strain. Gold, real assets, and inflation-sensitive investments have historically served as hedges during phases of financial repression or sustained inflation. Their role is not to predict collapse, but to offset potential dilution. The broader insight is structural rather than tactical. When sovereign debt rises and refinancing occurs at higher rates, policymakers must distribute adjustment costs somewhere. Through taxes, through spending cuts, through inflation, or through suppressed real returns. The distribution may shift over time, but it rarely disappears. For households, the risk is not a headline announcing default. It is the possibility that long-term savings grow more slowly than the cost of living. that retirement projections based on nominal returns fail to account for real erosion. Currency stability rests on confidence in fiscal sustainability and monetary discipline. When those perceptions weaken, even slightly, capital reallocates, exchange rates adjust, asset preferences shift. Understanding this dynamic reframes the question. It is not simply whether debt is large. It is how the chosen path of adjustment influences purchasing power over the next decade. And once we bring the issue down from sovereign policy to everyday life, the next step becomes practical. How do these currency pressures and fiscal trade-offs translate into mortgage rates, credit availability, and the resilience of a household balance sheet? We have walked through the math, the bond market mechanics, the global funding landscape, and the currency implications. Now we step forward and consider how this could unfold between now and 2026. There is no single path. Complex systems rarely resolve in clean lines. Instead, they branch into scenarios shaped by growth, inflation, policy decisions, and investor behavior. The first scenario is soft containment. In this path, economic growth stabilizes. Inflation gradually cools without collapsing demand. Tax revenues improve modestly as employment remains resilient. Deficits narrow slightly, not because spending disappears, but because growth outpaces projections. Interest rates begin to decline gradually as inflation pressures ease. Refinancing still occurs at higher levels than the ultra-low period, but not at peak rates. The debt remains large, yet manageable under improving conditions. In this outcome, savings face mild inflation pressure, but not dramatic erosion. Real returns fluctuate, but do not collapse. Markets adjust, but without severe disruption. The system absorbs strain and adapts. The second scenario is what we might call a rate trap. Here, inflation proves sticky. Structural pressures, energy costs, supply constraints, fiscal expansion prevent a rapid return to low-price growth. Central banks keep rates elevated longer than expected to maintain credibility. At the same time, debt servicing costs rise as large maturities roll over. Interest expenses begin to crowd out discretionary spending. Policymakers face tighter choices. Fiscal flexibility narrows. Financial conditions tighten meaningfully. Mortgage rates remain high. Corporate borrowing slows. Asset prices reprice to reflect a higher discount rate environment. In this scenario, savings are not erased overnight, but volatility increases. Real returns become uneven. The system feels tighter, more constrained. Pressure compounds rather than resolves. The third scenario is financial repression. In this path, policymakers determine that sustaining high rates is too costly for fiscal stability. Yields are guided lower through policy signals, regulatory incentives, or balance sheet tools. Inflation may not surge, but it remains modestly above target. Real rates drift negative over time. Savers earn returns below inflation for extended periods. Nominal balances may rise, yet purchasing power erodes gradually. Debt becomes more manageable in real terms because inflation and suppressed yields reduce its burden relative to income. The adjustment is subtle, spread across years rather than concentrated in crisis. For households, this can feel stable on the surface. There are no dramatic headlines. Yet long-term financial planning becomes more complex. Preserving purchasing power requires awareness rather than assumption. These scenarios are not predictions. They are frameworks. Debt crises in advanced economies rarely resemble sudden defaults. They unfold through policy adjustments, yield curve changes, regulatory shifts, and slow structural evolution. The process can appear orderly even as underlying dynamics shift. Non-linear events remain possible. A funding disruption or external shock could accelerate adjustments. But the more likely path involves gradual change rather than abrupt collapse. This brings us back to the central question. Is the true risk losing your savings overnight, or is it losing purchasing power quietly over a decade? For most developed economies, with control over their own currency, the latter has been more common. The burden of adjustment spreads across time through inflation, suppressed yields, or slower growth. Understanding this difference changes how we interpret the $30 trillion figure. It is not a countdown clock. It is a structural variable influencing policy choices and long-term returns. And the next critical variable lies ahead. Between now and 2026, a substantial amount of debt must roll over. The scale of that refinancing will test demand. Who will buy it? At what yield? Under what conditions? In our next episode, we will examine the 2026 refinancing wall in detail, the maturity schedule, the potential buyers, and whether global demand will be strong enough to absorb the supply without triggering the next phase of financial strain.